Now let's move on to the markets. Of course, the NSE, like I mentioned, has been up over the last two sessions, and today it's slightly higher, about 0.2% to 37,885 points for the NSE All Share Index. The gainers in early trade include Nestle Nigeria, Forte Oil, which of course reported results earlier this week, PZ, Cousins, and Dangote Sugar. Let's now cross to Dunlop Merrifield, where Abdul Garba is standing by to give us his thoughts on the market's performance and some of the news we're seeing from corporates. Thank you so much, Abdul, for joining us. So we'll get to the corporate news in a little bit, but clearly I think the good news is that the market is bouncing back after the decline we saw last week. What do you make of this rebound?
Well, it's mixed reactions here because it came to a pause when largely expectations were waiting for internal results coming from companies being the second half of the year. So all of that expectation built up, and then the crash, or how to put it, the slowdown of momentum that came with the announcement.
So you think this market is likely to go higher over the rest of this quarter?
Well, not to the extent that some sectors will contribute quite significantly to the market's performance. Yes, and these particular ones are the building material sector, but we have 2 out of 3 out of them basically leading all of that, and then the consumer sector.
All right. So what do you make of some of the results we're seeing? Let's start with Wema Bank. They swung into a profit after a huge loss, and of course the 2012 full year was really bad. We saw a huge loss there, and so I guess it's good news that we're seeing the regional lender beginning to move back into the black. Your thoughts about Wema Bank right now?
Yes, it's important to note that well, Wema is a turnaround story. It's coming from a period of difficulties through not just its own challenges internally, but also industry-wide challenges with which it has had to grow. So seeing these numbers coming from Wema on the back of its limited equity right now actually reflects some positive news.
Do you think this is something that investors should be looking at right now, or is it too early to say this is a buy?
Yeah, it is. It is. We would say yes. It is indicative of a probable turnaround, a strong case for a turnaround, given the limited equity it has. Let's not forget that there's been an attempt to basically shore up more capital and have Wema participate on the national space rather than the regional one, and it has pushed for that case. But first half numbers are based on what was available last year, much of the equity that was available last year, but nothing bigger than that. So if we have return on assets, though above zero based on what they have, and with all the competition going on in the industry, you would say, okay, maybe we should take a look at them and then give them a case.
Well, I just made that point about Fitch's rating of the banking sector. They are suggesting that profits will be hit, and I think that's echoing the sentiments of many analysts. What do you think? How bad is the story in the second half for you, for the banks?
Well, depleted incomes in terms of non-interest income, basically charges and all the clampdowns going on. But when it comes to the more recent effect, I feel that is transient. The effect of basically putting up the cash reserve ratio issues, where public sector funds are supposed to be provided for in terms of a cash balance to offset whatever has been deposited. Well, given that a lot of the banks basically have an almost indeterminate level of public sector transactions, you can't just pick that. It comes in and it leaves. But some are overtly dependent and some are not so dependent. And then in a scenario where you have that taken away and you have less liquidity in the system, we probably see more banks going to the interbank to borrow, and now it turns to a case to those that are cash rich basically benefit more than those that have to depend on what they borrow.
What do you make of Ashaka Cement? You mentioned the building materials as perhaps a sector that is likely to drive this market forward in the second half, but what do you make of Ashaka's numbers? Pretty weak. We're seeing a 62% fall in EPS for the first half.
Now, reviewing Ashaka's numbers, coming from years. Ashaka has been a stock that has been powering close to between 50-20% growth for at least 10 years. And well, except for the year 2010, 2011, in between, what we have is a dip, and we also see that happening again. The numbers are not impressive, you know, on a year-on-year basis. They're not. We have return on equity being very low. One looks through everything. You see the revenues are, well, we can't say decline in revenues to a large extent. It's a 3% decline, but a rise in cost of sales, you know, brings the concern here.
Right.
And it leaves us to say, okay, Ashaka's current location, operating location, and its area of advantage is in a troubled area of the Northeast. And that has been going through some crisis for a while.
Right.
Given that, we have also seen more profitable numbers coming from Dangote Cement and WAPCO, either from tax benefits or base expanding in expansion and all that. Ashaka hasn't, you know, met the 3 million metric ton capacity that it has promised, and though it has expanded assets, we don't see much in what it has used those assets to generate in terms of returns to shareholders. It leaves concern to say, okay, at this point we want to understand what the management, or you know, the sort of challenges that they're going through and why it sustains through this, because it looks rather bleak.